Most people do not see a shock coming. That is precisely what makes it a shock. I have spent more than 7 decades watching markets move, watching economies breathe, watching confident investors become frightened investors in the span of a single quarter. And what I have learned, the most important thing I have learned, is that the shock is never truly a surprise. The signals are always there. The data is always speaking. The warning is always written in plain language for anyone patient enough to read it. The problem is not that the warning is hidden. The problem is that in the year before the shock, everything feels fine. Everything looks normal. The portfolio is green. The headlines are encouraging. The dinner table conversations are about how much money everyone is making. And that feeling, that warm, comfortable, dangerously seductive feeling of normalcy, is the most expensive emotion in the history of personal finance. I call this the confidence trap. And in 2026, most of you are living inside it right now. Let us begin. I want to teach you something today. Not scare you, not entertain you, teach you. Because the difference between the people who navigate a market shock and the people who are destroyed by one is not intelligence. It is not luck. It is not connections or access or the kind of wealth that insulates a person from consequence. The difference is preparation, and preparation begins with understanding, clearly, calmly, without flinching, what the numbers actually say. Not what you want them to say, not what the television says they say, what they actually say. And what the numbers say right now, in 2026, is something that I believe every serious investor, every person with a retirement account, a savings plan, a financial future they are counting on, needs to hear before they hear it the hard way. Let me start with what I call the calm river illusion. There is a particular stretch of the Colorado River in the American Southwest where the water is perfectly calm for miles, glassy, still, beautiful. Experienced guides who know that river say those are the most dangerous miles of the entire journey, because just beyond the calm, out of sight, hidden by a bend in the riverbank, is one of the most violent rapids in North America. The calmness is not safety. The calmness is the river gathering itself for what comes next. Right now, the American stock market is that calm stretch of river. The S&P 500 has delivered extraordinary returns over the past 3 years. Volatility has been, by historical standards, remarkably subdued. Corporate earnings, at the headline level, have looked respectable. Consumer spending has held. Unemployment remains low. And retail investors, most of you watching this, have settled into the comfortable rhythm of a market that seems to reward patience without demanding discipline. That comfort is the calm water. What I want to show you today is the bend in the river. I want to be specific because specificity is respect. Vague warnings are for people who want to seem wise without being held accountable. I do not operate that way. So let me show you exactly what I am watching and exactly why it concerns me. The first thing I am watching is what I call the valuation wall. The price-to-earnings ratio of the S&P 500 currently sits at levels that have historically preceded significant corrections. The Shiller-Cape ratio, which smooths earnings over a full decade to account for cyclical distortions, is near 40. The long-run historical average is approximately 17. That gap, between where we are and where history says we should be, is not a minor statistical anomaly. It is a structural overvaluation that has only existed twice before in American market history, in 1929 and at the peak of the dot-com bubble in 1999. Both times what followed was not a gentle correction. What followed was a generational reckoning. I am not predicting 1929. I am telling you that the architecture of the current market has more in common with those two historical peaks than with any healthy, sustainably valued market I have observed in my career. That is not an opinion. That is arithmetic. The second thing I am watching is what I call the earnings illusion. In 2025, corporate earnings growth was real, but it was not as clean as the headlines suggested. A significant portion of that earnings growth came from two sources: share buybacks and margin expansion, neither of which is infinitely sustainable. When a company buys back its own shares, it reduces the number of shares outstanding, which mechanically increases earnings per share, even if the underlying business generates the exact same total profit. This is not fraud, it is legal, it is common, but it is also a way of making growth look faster and deeper than it actually is. And when the buyback cycle slows, because companies have taken on debt to fund those buybacks, and interest rates have not fallen as aggressively as many expected, the earnings per share number will stop growing the way investors have been trained to expect. When that expectation breaks, the price multiple contracts. And when the price multiple contracts on a market already priced at twice its historical norm, the mathematics of the fall become very uncomfortable very quickly. Now I want to tell you about what I call the rate reality. For the past 2 years, markets have operated on the assumption that the Federal Reserve would cut interest rates aggressively, flooding the economy with cheap capital and justifying the elevated valuations investors have been paying for equities. That assumption has proven stubbornly incorrect. Inflation has been more persistent than the optimists projected. The Federal Reserve has moved more slowly, more cautiously, and more reluctantly than markets priced in. And this matters enormously, because the valuation of every asset in a modern economy is connected, mathematically, fundamentally, inescapably, to the cost of money. When money is cheap, future earnings are worth more today. When money is expensive, future earnings are worth less. This is not a metaphor. This is discounted cash flow arithmetic that every serious investor should be able to recite in their sleep. Right now, rates remain elevated, and the market is still priced as though rates are about to fall dramatically. When that expectation finally collides fully with reality, the adjustment will not be gradual. In my experience, markets do not gradually reprice large structural misconceptions. They correct them suddenly, all at once, in a moment that observers later call a shock. Let me tell you about the debt spiral, because this is the mechanism that transforms a correction into a crisis. Between 2020 and 2024, American corporations, American consumers, and the American government all accumulated debt at rates that would have been considered alarming in any previous era. Corporate debt in the United States has reached levels relative to GDP that exceed the pre-2008 peaks. Consumer credit card debt crossed $1.2 trillion in 2024. The United States federal government is now spending more on interest payments than on its entire defense budget, more on the cost of the debt than on the Army, the Navy, the Air Force, and the Marines combined. Now you might be thinking, Warren, debt has been high before, and the system has absorbed it. You are right, and I want to address that directly because it is an honest objection. The difference between manageable debt and dangerous debt is not the quantity alone. It is the combination of quantity and the cost of servicing it. When interest rates were near zero, $1 trillion of debt cost almost nothing to carry. When interest rates are at current levels, that same $1 trillion becomes a slow, relentless drain on every balance sheet it touches. The debt spiral does not announce itself loudly. It works quietly, compressing margins, reducing flexibility, eliminating the buffer that companies and consumers need to absorb a shock without becoming the shock. I want you to understand something that most financial media will never say plainly, and I call it the retail sacrifice. Every major market cycle in modern history has ended the same way. The sophisticated institutional investors, the hedge funds, the sovereign wealth funds, the pension managers with teams of analysts and decades of pattern recognition begin reducing their exposure quietly, months before the peak. They do this slowly, methodically, without fanfare, and as they reduce their exposure, they need someone to buy what they are selling. That someone, almost every single time, is the retail investor. You, the person who has been watching markets go up for years and has finally decided that now is the time to participate fully. The person who increased their equity allocation in 2024 and 2025 because the returns were too attractive to ignore. The person who moved money from savings accounts into the market because the financial content they were consuming told them that staying in cash was leaving money on the table. I am not saying this to embarrass anyone. I am saying it because it is the mechanical reality of how market tops are built. Institutional money exits, retail money enters, and then the correction comes. And the retail investor, who bought near the top with money they genuinely needed, is left holding an asset that has declined 25 or 30 or 40%, without the financial cushion to wait for recovery, and without the emotional discipline to not sell at the worst possible moment. The retail sacrifice is not a conspiracy, it is a pattern, And patterns repeat because human psychology does not change. Now, I want to talk about what I call the volatility awakening. For the past several years, a widely watched measure of expected market volatility, the VIX, which traders sometimes call the fear index, has spent an unusual amount of time at historically low levels. Low volatility feels safe. Low volatility feels like the market has matured, become more stable, learned from its past mistakes. I have heard that argument in 1998. I heard it in 2006. And I can tell you from experience that extended periods of unusually low volatility do not signal a more stable market. They signal a market in which risk has been mispriced, where investors have become so accustomed to calm that they have stopped pricing in the possibility of disruption. When volatility returns, and it always returns because uncertainty is the permanent condition of markets, it does not return gently. It returns with force proportional to how long it was suppressed. A spring that is compressed for 3 years does not release slowly. It releases all at once. The volatility awakening in 2026 will not look like the slow, grinding corrections of recent years. It will look like something faster, sharper, and more disorienting than most current investors have ever experienced in their investing lives. You might be wondering what I think you should do. And I want to be clear, I am not telling you to sell everything. I am not telling you that the crash begins tomorrow, or next Tuesday, or in the third quarter. I have never been in the business of timing markets, and I am not starting now. What I am telling you is this: if a 30% decline in your equity portfolio would fundamentally alter your life, if it would force you to delay retirement, reduce your standard of living, or sell assets at the worst possible time just to meet your obligations, then you are carrying more risk than you can actually afford to carry. The question is not whether you can handle volatility philosophically. The question is whether you can handle it financially. Most people discover the answer to that question at exactly the wrong moment. What I have always believed, what the mathematics has always confirmed, is that the best time to assess your risk tolerance is when the market is calm, not when it is falling. Right now, the market is calm. This is your window. Build your cash position. Not because cash is a permanent strategy, but because cash is optionality. Cash is the ability to buy when fear is at its maximum and prices are at their minimum, which is the only time great businesses become available at great prices. My company is holding more cash than at any point in its history. That is not pessimism. That is the discipline of someone who has learned, through 70 years of observing human behavior in financial markets, that the investor who arrives at the bottom with dry powder does not just survive the shock, they use the shock. They turn the panic of unprepared investors into the foundation of their own next decade of compounding. That is not ruthlessness. That is preparation meeting opportunity. Those two things have always been the engine of serious long-term wealth. I want to end where I always end, with the only currency that cannot be printed, cannot be borrowed, and cannot be recovered once it is spent: time. I want you to picture yourself, years from now, looking back at this specific moment in 2026. The Buffett indicator at 224%. Corporate insiders quietly selling. Earnings growth built partly on financial engineering. Rates staying higher than the market priced in. Debt at record levels relative to the cost of servicing it. And a retail investing population almost universally positioned for continued upside. Will you look back and say that you saw the data and made a deliberate, informed, disciplined decision about how much risk was appropriate for your actual financial life? Or will you look back and say that you heard the music and kept dancing because everyone else was dancing, and because stopping felt uncomfortable, and because the story the market was telling was a story you very much wanted to be true? I have billions of dollars. I have every advantage that wealth can buy. But I cannot buy back a single year of a life spent rebuilding what a shock took away. I cannot give back the retirements lost in 2001. I cannot restore the home equity that evaporated in 2008. I cannot undo the human cost of financial shocks that the data in each case had warned about in advance, quietly, patiently, in the language of numbers that most people chose not to read. The numbers are speaking right now. They are speaking in 2026, in this moment, to you. The door to the cage is open. It has always been open. The cage is not the market. The cage is the story you are telling yourself about why this time is different. Walk out. not in panic, in preparation, not in fear, in clarity. The difference between those two things is the difference between the investors who remember 2026 as the year they got serious and the investors who remember it as the year everything changed and they were not ready. That is all. Thanks for watching.